We'll move into some discussion around the financial plan, broke up into three sections: preparing the financial plan, the process for adopting it, and how to monitor the financial plan throughout the year. A financial plan is a legislated requirement. Section 150 of the MGA requires that a financial plan be adopted, and it does specify what needs to be included. The financial plan includes the operating budget that likely everyone is familiar with, but also includes the capital budget and the 5-year capital expenditure program with asset management. Time doesn't permit getting into the details of each of these tools, but these links have been provided in your pre-session package with the online resources. There's also a municipal expenditure tool that has been created by the Infrastructure Secretariat, and again the link is provided with the online resources. Section 153 of the MGA does prohibit projecting a deficit in the operating budget and speaks as well to what the options are if a deficit is incurred. So what happens if a deficit is incurred? It can be offset by a reserve fund or surplus fund if you have those. The surplus funds would be funds from the previous year. There are also some municipalities that would set up a reserve fund, and there would be amounts that would go into this each year that would be available for specified things. If you have reserve funds, you must have a policy and a bylaw. So samples of each of these are included in the pre-session package, which is with the online resources. If you don't have a reserve fund or surplus funds from the previous year, you do have to make sure that when you're budgeting, that any deficit you have is included in the budget for the next fiscal year the same way you would include an expenditure for the year. Subsection 3 of Section 155 of the MGA does say that the minister must be notified in writing if a deficit is expected that's greater than 5% of revenues and transfers, and approval to incur a deficit must be received. This is essentially a safeguard to ensure that any trends in deficits are caught and addressed early to avoid mismanagement. If there's an easy explanation for the deficit, such as a harsh winter where you had increased snow removal costs, you would get ministerial approval. If there are things that flag mismanagement, you may not get your approval. Looking at the operating budget, it is made up of estimated revenues less estimated expenditures to give you a projected surplus or break even. On the revenue side, taxes is one area of revenue. Section 160 of the MGA permits the increasing of tax rates for the purpose of raising revenue to cover expenditures and any deficit that has been carried forward. Tax increases take effect on January 1st and apply for a minimum of a full calendar year. Tax year and fiscal year are different, as fiscal year is now April 1st to March 31st, and the tax year is still January 1st to December 31st. Each municipality does have access to up-to-date property assessment and tax information for their municipality through the online MAPCO tool. Each municipality is granted access to that by the province, so if you don't already have it, you just need to request it. Most municipalities would have more than one tax rate group, as they would have commercial and non-commercial rates, and in some communities these may differ as well depending on if they have serviced and unserviced areas. A reminder to ensure that you have a bylaw when setting up tax rate groups. There is a link to a sample bylaw provided in the pre-session package with the online resources. Other areas of revenue to be included in the operating budget include grants and transfers from governments, transfers from reserve funds, operating surplus from previous fiscal year, estimated revenues from public and municipal utilities and controlled corporations. And on the expenditure side, of course, you have your operational expenditures that you are going to account for. And you may have funding you are providing to community organizations. Just a word of caution there that these do count as grants and should be covered in your grants bylaw. And there should be a process to evaluate these occasionally to ensure that you're not prioritizing one group over another and that there is a public benefit. Also to include debt obligations, transfers to a reserve fund or to the capital budget, operating deficit incurred in previous fiscal year, estimated amounts to fund the expenditures of any public or municipal utilities and controlled corporations your municipality may have. And again, the difference between your revenue and expenditures, if you have any, would be a projected surplus. If equal, there would be break even, which is what you would hope for. A capital budget is part of this, so you need to include the estimates for the fiscal year of any capital projects you will be conducting. So you need to include any cost to acquire, construct, remove, or improve, and also the anticipated sources for these funds, including any amounts to be transferred from the operating budget or a reserve fund. The third component of your financial plan is your 5-year capital expenditure program and asset management program. You have to look at each proposed project for the next 5 years and include your planned capital projects beyond the current year. So this does require long-term planning for your municipality. You need to estimate the amount and source to cover the projects. The asset management program includes an inventory of municipally owned infrastructure, the costs required to maintain the existing infrastructure, and the costs required to maintain the infrastructure planned for in the 5-year capital expenditure program. An asset management plan is a requirement to be eligible for federal funding. It helps municipalities to get the most out of their infrastructure, helps to project life cycle costs, which can help with decision making on improvement versus replacement, helps municipalities to prioritize spending. Some considerations for development of the asset management plan. What do we own and where is it? What is its current condition? What is its value? What is its useful life? What do we need to do to it, and when do we need to do it? There are various resources available. The Infrastructure Secretariat has an information page, guides, and inventory forms. The Federation of PEI Municipalities also has some toolkits and guides. And Saskatchewan also has a YouTube video on municipal asset management that they've put together that is informative. Links to all of these resources are included in the pre-session package with the online resources. This infographic developed by the province takes you through the municipal expenditure tool process and can be a useful tool in demonstrating to council how it all works. Please take a few minutes to think about what things you would consider to develop your annual financial plan. I will then share my thoughts. So some things that should be included in your process, and of course there may be others as well that you've thought of. So a review of historical actual expenditures and revenues, consultation with department heads and committee chairs, consultation with provincial government departments regarding municipal and provincial funding agreements, realistic estimates for repairs and maintenance, and wish lists for capital expenditures and annual planning and prioritization. Everyone would certainly be aware that the CAO needs to prepare or have prepared a draft financial plan and provide information for council's review, to facilitate council's budgetary discussions, and to provide information to the public with respect to the financial plan. So it's really important that you have a well thought out plan going into these processes. We will talk a bit about the adoption of the financial plan. Section 150 and Section 151 of the MGA require that council adopt the financial plan and that the public has an opportunity to provide input. Opportunity must be provided to residents to participate in a financial plan meeting and that must occur at least 2 weeks before the financial plan is adopted. Information is provided to the public about the financial plan, but the members of the public do not vote on the financial plan. It's Council's responsibility to adopt the financial plan on or before March 31st, and the adopted financial plan must be filed with the Minister by April 15th. The MGA does leave the format of the meeting for public engagement and level of engagement up to each municipality, so there are some differences there. Some asked for comments on a finished budget, and others might use the meeting to identify community priorities. A capital budget may be adopted by resolution prior to March 31st, separate from the rest of the financial plan, and if it is adopted prior to the financial plan, a public meeting is not required for that component. Some reporting dates to keep in mind. January, February, the financial plan should be under development. You should be planning for public meetings and for council approval. March 10th to 12th is about the latest date that the public meeting can be held and still meet all your deadlines. By March 31st, council needs to adopt the financial plan. And by March 31st, any tax rate changes need to be submitted to taxation, and those would be retroactive to January 1st. And then by April 15th, the approved financial plan must be submitted to Municipal Affairs. We will talk a little bit about monitoring the financial plan. So the financial plan has been adopted by Council. What happens to it next? Is it filed away until it needs to be prepared again next year, or do you implement a monitoring process around it? There really does need to be a monitoring process put around it. Most accounting software allows for the input of actuals and budgets, so the budget amount should be entered into accounting software to allow for monitoring throughout the year. This allows for easy comparison to actual as you go through the year. Your financial plan should guide expenditure decisions made throughout the year. However, if something has not been set out in the budget, the Council may authorize an operating or capital expenditure if its spending will still be within the total budget estimates. Council may spend from its operating budget as well to transfer amounts to the capital budget if funds are available. Capital expenditures not in the capital budget can be authorized by Council if the amount does not exceed transfers from operating, borrowing, or transfers from the reserve fund. But there needs to be procedures for authorizing and verifying expenditures that are not included in the financial plan. The financial plan must be revised by resolution to reflect any changes not in the original approved financial plan. The financial plan shows the maximum amount that is approved for expenditure. It is both a plan for expenditure and a policy document because the development of it has outlined the services you are going to provide in your municipality. It definitely should be monitored as you move through the year. If spending in a way that is not consistent with the approved annual budget, this is a red flag that will require further review and explanations. There has to be good reason for not adhering to the financial plan. What financial information should be provided to Council? Council should be monitoring the financial affairs throughout the year against the plan. This slide demonstrates a way that you could set up your financial reporting so that they have the information they need. It provides the expenditure description and actual year-to-date with a comparison to the budget amount, and then the variance is calculated. These could be provided monthly or quarterly. The reasons for variances should be provided. Signing authority is one of the fundamental internal controls required by the MGA. Checks, e-transfers, agreements, contracts, deeds, other legal documents, and financial instruments must be signed by both the CAO and the mayor. Payments must be matched to documentation. Blank checks being signed is not a good practice. Contracts and agreements under $25,000. By council resolution, the CAO can be authorized to sign those contracts or agreements alone. We do get some questions that arise about signing authority. One is how to deal with vacations where the mayor or CAO will be on vacation, so only one available for signing. This can be dealt with by good planning in advance, so having the invoices and checks ready for signature as per normal prior to the vacation. Can also have a designated signing authority or delegated signing authority designated in advance to carry out the duties of the mayor or the CAO. This would need to be authorized at the bank as well. Another question is, can the CAO sign their own check? So if there is an invoice, or an authorized expense claim, or a payroll stub, this should be okay as long as the mayor has signed as well. The mayor would certainly want to take extra caution to ensure that the documentation is available and to compare payroll amounts to previous periods. Another question is, how do we address checks and balances with only one employee to protect both the CAO and the council from concerns and accusations of fraud or theft? Certainly effective policies and procedures are really good, as you can point back to following what is in place. Another process would be two people signing the checks and authorizing payment. Third would be regular monitoring of actual versus budget and investigation of discrepancies or variances. Keeping track of the age of accounts receivable and accounts payable, sending statements for accounts receivable, having a bank reconciliation prepared. And if there is only one employee, that bank reconciliation could be done by the chair of finance. Requiring documentation to support expenditures and requiring that be reviewed, not just attached before signing checks. These are all important processes that can help with protection against those allegations.